Hi, I'm Peter Rose, founder of Longwood Currency Trading. Is your entry stop getting hit too many times? That seems to be a question or a problem that a lot of the folks that email me or work with me seem to have in their trading. And not just beginners, it's folks that have been trading for 2 or 3 years that I hear that. There's only a couple of reasons why your entry stop is getting hit. Either your stop is too short or you really don't understand entry analysis. Now, it would seem that the obvious reason is that your stop is too short because everybody that you listen to or hear or the advice that you get is don't set your stop too short. They give the price room to breathe is the word, the phrase that I hear all the time. I have to laugh about that. How much breathing room do you want to give it before you choke your account to zero? You know, if you have a trading one full lot at $10 a pip, and you take a 20 pip stop, that's $200. You get 6 losses in a row, that's $1,200. To trade one full lot's going to cost you $6,500 or something like that in margin, $6,000 in margin if you're US, and you're trading with a $7,000 account. You've just now gone below margin, and you don't have enough money to make that trade again. Well, shorten it up to 10. Well, is it really the stop? There's two things in consideration here. There's the stop and your risk as a function of your ability as a trader, which is manifest in your win-to-loss ratio. Not risk reward. That's craziness. Put that out of your head, because people that talk about that don't know what they're talking about. Your win-to-loss ratio. How many times do you win as a percentage of how many times you lose? So your 60-40 trader, you win 60 times for every 40 you lose. You win 6 times for every 4 times you lose. It's still 60-40, right? So you need to do some calculations. If you're a 60-40 trader and you're losing 5 times, you're a jump ball trader, and your stop is, let's say, 10 pips, and you're skilled enough to get 10 pips when you win, you're 50-50, and you're break even. So now you go to that 60-40. You win 600 and you lose 400. You win 200. You divide that by the 10 trades. You're making $20 a trade. Is that sufficient compensation for the risk that you're taking overall as a trader? So that stop is an important metric in your analysis of how well you are understanding the process of evaluating your entry. In the folks that I work with, I teach them the life cycle of a currency position, which is a rip against my 33-year career as a software engineer. Software development life cycle, a process to solve complex problems. So the life cycle of a currency position has 3 problems to solve with that position. From the time you bid ask till the time you get out and you exit. So you've got your entry analysis, then you got a position management, you got to manage that position, and you have exit methodology. If you don't get your entry analysis correct, you don't have a position to manage or a position to get out of, because you've already been stopped out. So your entry is really critical. What happens when your analysis and your entry isn't so good? Your price goes against you. How far are you going to let that price go against you before you recognize either the stop is too tight or you're doing something wrong? You can't say that prices random and you don't know what the next tick value is going to be. It could be 50% chances that the next tick is going to go up and 50% chance it's going to go down. But if you've got your entry analysis correct, that determines the momentum of the price and the direction of the trend and all that other stuff that your entry conditions consist of, then that's your edge. If you have a good rule with good conditions that you say, unless all of these conditions are satisfied, then I don't enter the trade. So if you're entering the trade and you're getting stopped out too many times, then it must be your entry that's wrong, analysis that's wrong, and not where the stop is. Where the stop is really becomes immaterial. If you're a 70-30 trader, put your stop out to 20 pips because you'll give it room to breathe. If you're experienced enough, you'll know the difference between a breathing retracement and a retracement you got to really worry about. You know, if you're going to stand there and try to put a trade on right before NFP, you're going to get wiped out regardless of how good your analysis is. It doesn't make any difference. It's going to go in both directions. Where have you seen an NFP where you haven't ended up on that candle, that maybe that 5-minute candle ends up being kind of sort of like a doji, right? There's indecision there. People are getting out because they were wrong. People are getting in because they're in with the flow of the trade, and then it starts to turn around and go against them, and then they go out. There's all this confusion and stuff that goes on. But in normal trading, I mean, if you're basing your metrics on the last 10 trades, it's ludicrous. You need about 100 sample size of trades over about a 6-month period of time, at least, in order to have experienced all the different conditions that the Forex market is going to present to you, so that the metrics that you come out on a 60-40 trader are valid. So if you're a 60-40 trader and you're getting stopped out more times than you should, then you're not a 60-40 trader. You're just lucky in your entry analysis that during the period of time that you have been trading, you've got the 60-40 statistics, and now things are going against you. Why are they going against you? Well, let's say you're new to the game. You got a 60-40 trading metric, and you've been trading for 3 or 4 months in a live account, and things have been going great. You're 60-40, maybe 70-30. And now all of a sudden, you're upside down. You're a 30% winner and 70% your stop's getting hit. Why is that happening? Well, maybe it isn't the entry analysis that's wrong. Maybe you only are familiar with the trend that price has been going in, and you don't really understand what to do when the price goes, first of all, into a chop, or you get a pin bar, or you get a retracement. Is that retracement going to end up being a swing point, or is it simply a 10 or 15 pip retracement, or a 5 pip retracement if you're on the 5-minute chart? Where are you involved here in your lack of understanding of the price action in a chop, or now going into a range-bound movement? Maybe the trend is continuing, but the trend is now continuing in a range-bound upward pattern, let's say, for a long position, where before you were just really going in an upward direction, and any dumbass can make money that way. There are so many trend traders who ended up losing all their money, not only all the money that they made, but got their accounts cleaned out when they learned how to do this stuff on a trend, and when they got into a range bound motion, or that, like I said, a swing point, which might be a blow off and a pin bar, they didn't know what to do with it, and they stayed with that particular way of trading, even though that's the wrong methodology to use at that particular time for the price action that was going on. So yes, it is entry analysis, but it's more than entry analysis. Maybe you don't really understand the diversity of that price action has, and how to trade swings, range-bound movements, trends, trends interrupted by a sharp down spike with a continuation of trend as evidenced up on the daily chart or the 4-hour chart. If you're unfamiliar with the key characteristics of price action, and in particular the difference in currency price action than you would find in commodities or options, stock options, or stocks themselves, penny stocks even, because of the purpose of the currency market and why that's working. If you just had somebody teach you an engulfing candle pattern, and when you see this pattern, then you do X, Y, Z, that's called a system. Systems don't work. They generally break down. And people don't trade really by the system. They trade by their experience, with the system being a confluence of their understanding of what's going on. That's like somebody that's trading a Bollinger Band says, well, when this hits the top end of the Bollinger Band, and do we even know what that represents? But when it hits the top end of the Bollinger Band envelope, it should retrace. There's a 98% or 95% chance of retracement off of that line. Well, why? Somebody created the standard deviation value that is being done on that Bollinger Band. What does that mean? What does the currency market care about a standard deviation from the mean? What does it care? Is everybody in the market acting toward the mean? No, that's not the case. The mean is an artificial construct of a combination of a really good volatile price movement averaged in with mediocre range-bound price movement. I mean, if you're looking at a 21-period moving average on a 4-hour chart, well, you're going to run into the flat line, the decaying price action as the two pair countries go into hibernation. It closes. You know, everybody, you go to the New York Open and you get the Europeans about halfway through their session, and you get this big influx of orders and all these candles going in every direction possible, right? And then around noon time, East Coast, price begins to settle down. So by 2 or 3 o'clock in the afternoon, the bank traders, the institutional traders are balancing their books and managing their clients and client orders. And the European markets are 4 or 5 hours ahead of where we are, and they're done for the day. And so you get this really close range bound movement. Well, that's being factored into that 21 period moving average. So how good is that? How good is that going to carry you, depending on the time of day that you're trading? So that has to come into your entry analysis. So if you don't understand all the pieces and how they fit together, then how would you expect that your entry is going to go in the direction that you want it to go in, and the stop isn't going to get hit? It isn't getting hit because it's too close. It's getting hit because of something else. So if you find that it's getting hit too many times, don't increase the distance of your stop, because you're just going to lose more money. And you can't take the average of the retracement over a large sample size of data, because again, you run into the averaging out of high candle movement distances with low range candle movement distances. So you're getting a false sense of what the average price is doing. And median does you no good in looking at the averages in trading. So you have to really be visually aware. And that's why we do multiple time frame analysis, so that we can see, if we're day traders, which is what this channel is all about, day trading, down on the 5-minute chart. That doesn't mean you're doing your setup analysis and entry analysis on the 5-minute chart. You're doing that up on maybe the 4-hour, or at least the 1 hour. And then you're setting your entry and your stop points and all that other kind of stuff, your pending orders, perhaps on the 15-minute chart. Once that entry is hit, you're going to drop to the 5-minute chart and you're trading on the 5-minute chart or the 1 minute. And if price goes into a chop, you may be down on the 5-second. Oh, that doesn't make any sense. Well, that doesn't make any sense because you really don't understand the full scope of entry analysis. It isn't just, am I going to take this trade right now? It has to be based on something else. Is the momentum of that price at that particular time and the size of the candles increasing such that there's a high probability that price is going to continue on in an upward direction? Well, if it is not sufficient momentum, then the probability of it continuing in that direction is less. Do the conditions in your entry analysis, or do you even have conditions for that in your rule for entry analysis? So that you're not just looking, oh, price right now is doing this, and so I'm going to jump on board with a 2-lot. If you're a scalper, then that's what you do. You don't set stops as a scalper. You're in and out. You might do 5 or 6 trades in 15 minutes or an hour, and then you're done for the day. But scalping is a whole other different animal because it's not based on the ability to trade by general trading rules because of the fractal nature of price action. You're getting false signals on the lower time frame charts, like if you're looking at, I don't know, head and shoulders patterns, if that happens to float your boat, and you see that forming on the 5-second chart doesn't mean anything. Forming on the 1-minute chart doesn't mean anything. Forming on the 15-minute chart, it doesn't mean anything. So if you're a scalper, you're not looking at any of that. What your ability as a scalper, as having traded as a day trader, so that you're trading, you've got on the 5-minute candle or 5-minute time frame, you've got 12 possible decisions an hour that you can make, either to get into or get out of a trade or just to see how the market is going. So in the 2 hours that you have before heading off to work or after you get home at night before you go to bed, those 2 hours, you can trade during those 2 hours on the 5-minute chart. You have 24 opportunities to figure out what you want to do. That skill enables you to develop your experience and your intuitive interaction with your trading, such that if you decide you're going to go into scalping, all those rules and everything are embedded in you so well that you don't have to think about them. It's just like somebody who's a swimmer. At first you have to think about how you cup your hands and how you move your arms and how you do your body and how many times you turn your head. Once you've done that a gazillion times, you're just doing that. Now you're looking at increasing your edge at other things. It's the same thing in your trading, right? I mean, I think we all understand that. It's just how do you bridge that gap between the strict following of the rules to one of trading with experience and trading intuitively. Where does that come into play? Well, again, you need a couple of years or so of trading so that you've seen the full spectrum of price action on a multitude of different time frames, and you've experienced different, well, I guess crisis events. You know, 5-minute chart, you might get a 60 pip move when the ATR is 5 pips. And so you've seen that. You know that that's possible. And so you're judging your experience and you're seeing, well, you're trading into that potential 20 or 30 pip move when the ATR is only 5 pips because of your experience is saying, this thing is building. It's building. You're watching the order flow and you want to be on board for that when it kicks, and you want to have your finger on the close all button in case it turns around very quickly on you, because we've all seen the 5-minute candles going up. Instead of 5-period ATR, they might have a 10 or 12-period ATR as you get this acceleration in time. And that doesn't go on very, very long. And then you get this pin bar on the 5-minute chart. Well, if you go out to the 1-hour chart or the 1-day chart, you don't see any pin bar. You don't see any of that. So if you're trading on a daily chart and you're not seeing this 20 or 30 pip downgrade, other than the fact that the price is going down, and you have no structure around you to say, oh, well, this is why this is happening at this time. We had an acceleration in price. That's a blow-off. Do you trade a blow-off? No, you don't trade a blow-off. You exit into the blow-off. That's all part of the background of what your entry analysis is preparing you for. It's foreshadowing what's going to go on later. So if your entry is getting hit too many times, then you are not really foreshadowing from a future price action. From a probabilistic standpoint, you're only going on hope, fear, and greed, and you are perhaps too early in trusting your intuition and your experience. 6 months is not experienced. It's experienced enough for me to work with somebody to help them because they've had enough experience at failing and doing things, and they understand what they're not consistent, and they think they know why, but they're not really sure how to put the pieces together. That's where I would come into play and talk with them and try to get them squared away. And if they felt uncomfortable with their ability to be able to figure all that stuff out, they don't know where to reset their training from, well, then we could take a course and work through the fast track course. 6 weeks. Boom, it's fast. It gets done with. In fact, most of the heavy duty stuff is done in 2 weeks. So the rest of it is just getting in and peeling the onion back and getting more depth. Well, how would you get that depth if you didn't have somebody to guide you? If you have otherworldly experience, then you understand how to study things, and that it takes time to learn how to do things and how to break problems up into small pieces. Well, the entry analysis is a small piece, though the most important, of the 3 pieces of the life cycle of a currency position: entry analysis, position management, and exit methodology. So you've got to get your entry analysis correct. If your stop is getting hit too many times, don't change the stop. Go into your entry thought process. Why did you take the trade? Why did you take it where you took it? Instead of waiting maybe for another 5 pips, you get a confirmation. Yeah, well, that's moving in my direction. It didn't turn around after I took it and moved 3 pips, and then it took an 8 pip dump on me, and then it continued on down from there. Well, what distance does price usually have to go before it confirms the direction you're moving in? Maybe you're doing what I call anticipatory trades. That you're saying, oh, well, the price action here, if it does this, it's going to continue to go up, and it's going to get to my profit target, which is 15, 20 pips, 30 pips above me. And so instead of waiting 10 pips to get in, I'll take the trade now, and I'll make an extra 10 pips on the trade. So instead of an 8 pip or a 12 pip average on this, I'll get 18 as an anticipatory trade. Those are deadly. They don't work. You have an 80% chance of an anticipatory trade going against you. Why would you take an 80% chance? Because you don't understand that you're doing an anticipatory trade. Because if you understood that, you wouldn't do it. So that's where a course might come into play as we analyze price action and what's going on during the price action and what time frame are you on, such that the candle differential in size from the ATR indicates sustained momentum in a particular direction that you're interested in price going in. Or if it's doing this, what does that mean? So if your entry stop is getting hit too many times, don't worry about the stop. Leave it where it is. Don't try to change 2 things. I'm going to change my stop and I'm going to look at my entry. No. Leave the stop where it is and look at your entry. If you're convinced that your entry is as bullet tight as it can be, then maybe your stop is too close for the time period that the currency pair is involved in, or maybe it's just too much for the currency pair itself. You know, you have some currency pairs with a 5-period ATR of maybe 15 pips. They're crosses or exotics. They're not major pairs. I wouldn't trade a cross or an exotic. because there's too much variation in there. I don't need to trade across New Zealand dollar and Swiss franc or something. I don't need to trade that cross. I'm in the United States. U.S. The Euro USD and the GDP USD pairs constitute about 85% of the volume of the currency market on a daily basis of $6.7 trillion. So why would I trade some exotic, the Thai currency with Indian rupee, and why would I do that when the stability of the market is in its just the size of that market, what we call the liquidity, right? And so you have to look at those things before you make the decision. My stop's too close, or my entry analysis is invalid. It may be your entry analysis may be fine. It's just the market is undergoing such radical changes. Maybe you've got an NFP, and the next time you've got a producer price index the next day, and the president gets out and says some economic crisis thing, and the market's just all over the place. Or when you go into the fourth quarter and folks are closing up their books and clients are making their final requests for international currency exchange for economic transfer, get that done with by the end of the year so they can reset the button for the next year. Those might be periods that you don't want to trade in at all, because they're anomalies to what you would call normal price action. So you can't look at your entry stop and say, well, that's not getting hit too much, but I'm still getting stopped out, then it must be my entry analysis. You got to look at the overall market as well. So lots of stuff to think about. If you have any questions, throw me an email. Tell me a little bit about yourself and your trading experience, so I've got some context to the question that you're asking me, and maybe we can figure something out together. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.